Hello, everyone, and welcome to BFW 2401 Week 10, Part 2. Now, we talked in Part 1 about the off-balance sheet business, which is the non-market related. Now, here we are talking about the derivatives, which is the market related, which is the second part. Now, if you allow me to, we have only a few contracts, and hopefully we'll finish it in reasonable time. Now, if you allow me to share my slides, let me go to so we are talking here about the part 2, which is the financial derivatives contracts. And actually, when we talk about it, we want to mention that derivative contracts are actually market-related transactions. So if you are doing any contracts, whether for hedging or speculations, when I say hedging or speculations, either you want to protect yourself from the price, or maybe you are taking some type of speculations without any underlying assets. You can do that. You can sign forward contracts for commodities. You can do it for gold contracts. You can do it for oil contracts. You can do it for interest rates, for equities. You can do anything. All you need to do is, it's a promise to pay in the future. Then in this case, to buy or sell in the future, and you want to actually hedge your position. So let's go and see what we are talking about exactly. Now, 90% of the total derivatives and OBS businesses is actually coming from those what we call derivative contracts. Now, and those examples, as I told you, we can hedge or speculate in foreign exchange and gold contracts, interest rate contracts, equity contracts, and commodity contracts. We are interested in this part. Actually, the contracts we are doing, we are trying to use derivatives to hedge or speculate the interest rate contracts. And therefore, we are talking about forward contract or FRA agreements. We can talk about swap contract, future contracts, and options. Maybe you have noticed that I make the forward contract in red because actually it's the one that we will discuss and make calculations in details in this part. For the swaps, futures contracts, I'll just mention it in theory. Now let's go to the forward contract. Forward contract, there is a buyer and seller. Now, the most important thing when we talk about buyer and seller, we want to know how that agreement works and who pays who and when. Now, let's talk, let me give you an example. Assume a bank is committed to pay a loan in 2 years' time. And in that loan, for example, they are charging 8%. And when they charge 8%, they know that they will take the deposits. They will deposit as 7%, either from CDs or from any other sources. Now, the problem is, what if the interest rate after 2 years goes to 8% or 9%? That is a problem, which means your commitment to give the loan, you will give it in losses, because that loan is fixed and you have to charge maybe 8%, assuming that you are going to get the the resources of fund by 7%. In this case, you go in a contract. And this is to hedge yourself. So we call it FRA, so fixed rate contract. So as a buyer of this contract, which is the bank, will pay all the time 7%. Because, for example, you are taking from your borrower 8%, you will pay 8%, 7% for whom is going to go in this contract. And the rest will be 1% for your profit, for example. Now, what if the rates, if the sources of fund and the cost of funds goes to 8%, then you have a problem. You need somebody to pay the 1% more. So because you cannot actually pay that 8%, you need to have, you only want to hedge with 7%. So if the rate goes to 7%, the seller will pay to the buyer. But what if the rate goes to 5%, then the buyer will pay to the seller. How much they will pay? 2% here. And how much the seller will buy to the buyer? 1% here. End of the day, if you can see, the buyer, under any circumstances, he will pay 7%. So in this case, for example, when the interest rate goes down, he will pay 5% to the bank, to the market, to raise to raise the fund, and 2% will be paid to the bank, to the seller. In this case, if the interest rate goes 7%, he will pay 7% to the market, 8% to the market, 7% from the bank itself, and 8% will be given by the seller. You can see now you can fix it under, you can use this argument under whatever contract. You can take the buyer, depends on your exposure. You can take the buyer position or the seller position. In other words, the direction of the payment depends on the direction of the movements of the interest rates and on who is the buyer and who is the seller, okay? So in this case, if the interest rate rises, as you can see, the FRA rate is 7%, the market 8%. Who pays now? For sure, the seller is paying, and the buyer is gaining. So the seller, for example, here, the seller is losing. %, okay? If the interest rate falls, for sure the seller gain and the buyer loses. Okay? So this is how it works, actually, the contract. Now, let me go to the next contract. This is just, we finished the FRA. In theory, we'll do discussions later on. The swaps. The swap is different. The swap is the same thing, but actually it's a different way. So let's take two banks, for example, just an example. Let's take, for example, Maybank here, public bank here. Public bank, when I say this is a big bank, big private bank in Malaysia for international students. And for example, here a Maybank. Now, look at their, for example, public bank. Let's make it here. Public bank, maybe this will make it easier for you. And this is, say, maybe Maybank, okay? Now, here, for example, the public bank is actually the lenders in the physical market is a fixed rate, which means the lenders, the people who give him the funds, which means the depositors now, maybe they are receiving, they are giving the funds as a deposit and getting 8%, 12%, for example. Now, in the same time, he's taking this money and he is give it to a borrower, maybe businesses. And when he give the businesses are actually worried they don't want fixed rate, they will take it in floating rate. You cannot tell them, yeah, I can only give you in fixed rate. They will accept floating rate. The problem is, what if the interest rate goes up or down? Now, if the interest rate goes up, it's good because he will benefit from this. But if the interest rate goes down, maybe to 10%, the borrower will pay 10%. It's not even enough to pay the lenders the fixed rates. So in this case, he has to go and swap contracts. Maybank, you will find somebody else who is taking the different position. The different position, for example, for Maybank, he is actually, his lenders, maybe he's taking CDs, and it's from floating rate. And he takes this money and he gave it as a fixed rate. Maybe he gave this as a housing loans. This is housing loans. Now, this housing loans and some type of rate. So in this case, you need only to you need only to swap the changes in the interest rate. So Maybank now will find some other party who has just the opposite position. So his lender is fixed rate, his lender is floating rate. His borrower is floating rate, his borrower is fixed rate. You see? So what you do is now, this will actually swap, Maybank will swap the fixed rate, and he will get the floating rate. And he will pay to the lenders. Public bank is happy because he will we will pay the floating rate, which is going from his borrowers, and he will receive the fixed rate and give it to his lenders. And the situation is solved among the two banks through these swaps. Now, this is when we do it for hedging, but we can do it only for speculations. Now, let me just explain it here. An interest rate swap is an agreement between two parties to exchange interest payments on specific dates, which means in 1 year. They can do it here in 1 year or periodically. So the most common is a swap between fixed interest payments and floating interest payment, as we did here. Settlement is by payment of the interest rate differential, which means now only the changes in the interest rate, regardless how much this guy is lending and how much those borrowers are taking, same thing here. Regardless of how much they're paying or lending, you are only worried about the changes in the difference, assuming that same change in the floating and the fixed rate will be across the market. Now, a swap is actually in this case like a series of FRAs, because every time the rate will change, because the FRA is a contract with maturity. This one, every time the rate will change, the swap will happen. So the counterparty who swaps into the fixed rate, as you know, which is who swap the fixed rate, who is the swapping fixed rate? Now, for example, Maybank here. In the swap agreement, will gain if the market interest rate rises. So if the market interest rate rises, he will give the fixed rate. Public bank will give the floating rate, and the floating rate is higher. Now, what if the case is different? Now, the counterparty who swaps into the floating rate, this guy who gives the floating rate and receive the fixed rate, counterparty, maybe this is public bank. Public bank will gain when? In the swap agreement, he's swapping the floating rate. And the swap agreement will lose if the market interest rate rises and gain if the interest market falls. So if the interest rate, if the interest rate in the market goes down, so he will swap a floating rate, which is less, and receive a fixed rate, which is higher. So it's different positions, and then you take any position you like, depends on your exposure. This is actually the swaps. And it's, as I told you, it's theoretical one. Now let's talk about the future contracts. Now, future contract is a contract, not a physical transaction. It is just a promises. It's a counterparty who buys a future contract, is not actually buying anything at the point in time. So to buy a future contract means to enter into a contract or agreement, which you promise you will buy in the future. To sell the future contract, you can you can be a buyer or seller. You just promise to sell, you promise that you will sell in the future. Now let me, this is just more explanation here. So example of a trading and a futures, if the bank buys a bond, future contracts, we have, which I will show you now, then when it closes its position, it must sell. But when the, if the interest rate now fall, bond prices will rise and the bank will sell in profit. If the interest rate rises, now the bonds prices will fall and the bank will sell at losses. Let me take this example. That, you know, the settlement by, you know, look at this, for example. If it is now in March, now we are in May, but maybe you are in March. So if you buy 20 contracts at 8%, because they sell this contract on 100% and and a multiple of this is how they do interest rate future 90 days bank bill future contract, which is 100. This is how they sell it and how they trade it. They trade actually the interest rate, but they the 90-day bank bill future contract is 100. So you buy 20 contracts at 8%. So the price is 92. Now in June, for example, after 3 months, if the interest rate increases by 1%, so you are buying, right? Now you have to sell when there is a changes in the interest rate. So you enter here as a buyer. You can go enter as a seller, but you buy 20 contracts. When the interest rate is 8%, please concentrate on the interest rate. Don't concentrate in the amount. So that made, when you decrease 100 from 8, it's 92. So when the interest rate increases by 1%, which means now the price is 91. And you must to sell by 91. So you bought for 92 and you sell for 91. So actually you are making a loss of 1. But what if the interest rate falls by 1%? Now, in this case, the contract, the bond will increases, which means you sell 20 contract at 7%, 7 minus 100, you have 93. So you make a profit because of $1 because you sell now for 93 and you bought for 92. This is how the future contract work. And you know, all this is actually the terms between the two parties, but the most important thing is the calculation here. And you can look here, the future contract, it's a quoted and price basis, which is calculated as 100 future. This is why I told you 100, because you take the 100 minus the 8, or here minus the 8, here minus the 9, here minus the 7, okay? So therefore, the interest rate increases, prices falls, interest rates falls, prices increases. Interest rate, for example, if you have interest rate of 5%, the price will be 95. If the interest rate is 11%, the price today will be 89. Now, if you go in a buyer and seller later on, if the prices change, it depends on which position you are taking. Because if you take the buyer position, you buy, you have to sell next when the contract matures or the interest rate changes. If you are taking the seller position, you will sell now and then you will buy with the new price. So your position will be actually changing according to that. So I want you to understand it from this perspective. It's very straightforward, very clear, okay? Hopefully. It's a little bit, it can be confusing if you started to, but just think whether you are a buyer or you are a seller, and that the price of the contract is actually minus the interest rate. And when you are a buyer, you have to sell later on. If you are a seller, you have to buy later on. And the difference between the buying and the selling is actually your profit or your losses. Now we have also options. And the options you can see, they can go up, down, the prices moving all this, you know, around. So the prices always keep changing. So I don't want to play with this much, but this is how the move of the options. So now we have two options when we talk about interest rate. We have what we call the banks deal in this over-the-counter market, interest rate caps and floor. This is options. The purchase price of interest rate cap pays a premium of the right to limit the maximum interest rate he can be asked to pay. So this is a cap, or you can take a floor, which means that you will pay the difference if somebody will pay the difference if the interest rate going under the floor, which means just to, first of all, I want to tell you that if you are a borrower, you will ask for those cap options. What do you mean cap options? If you are making a limit that you want to buy 5% as your obligation for the loan, and you buy an option and you make the cap as 5%. Now, if you borrow in floating rate, if the interest rate goes over the 5%, you will exercise the option. And somebody will pay you the difference between the 5% and whatever is the rate now. But if the rate goes down, you will not exercise the options and you still pay the 5%. Because if you are going to trade, which means you will pay the 5% and you receive less than that, which actually for sure you will not exercise the option. Now the floor is different, it's the interest. So if I'm an investor and I think the minimum thing I can receive for my investment is 4%, I will buy an option. If the interest, it's a floating rate, I bought my money in floating rate. If the interest rate goes under 4%, which is the floor, somebody has to pay me. So I always keep receiving 4%. And this is why I have to buy what we call a floor option. The cap option for the interest rate, as I told you, I don't want to pay over 5%. And in the floor option, I don't want to receive as an investor less than 4%. So it's different cases. When using cap, he doesn't want to pay more than 5%, and the other using floor because he doesn't want to receive for his investment anything less than 4%. That's all about the 4 contracts. So actually, theoretically, we already finished all those contracts. Now, in the calculation, we will only use actually what you call the derivatives. Now, the derivatives is actually, we are talking about the forward contract. So the forward contract, we can use it for speculation. This is just to map your thinking, or we can make it for hedging. So we are talking about hedging, speculation, or hedging. This is arbitraging and speculation. There is no underlying contract. There is nothing you want to, and you can use it for risk management. Now, actually, the speculation and arbitraging and hedging looks the same. But here you have a physical, what you call a physical exposure. Now let me explain it. How does it work? But this is actually the agreement and details about the agreement. I'm interested in the calculation. This is how the quotation comes. The quotation will come 3M V9M, which means this is a contract that will be exercised in 3 months. But the contract for 9 months. So you have to discount from the 9 months to the beginning of the 3 months. And then they will give you this quotation also, the FRA rate. This is the rate of the contract. And this is the contract, 500. And it's OTC contract. OTC means on the counter. It means party to party, party to party. It's not sold like standard contracts in the like future contracts when it is standard contracts sold in the Security Commission. No, this is, you can sign it for 500,000 or 5 million or 500 million. It depends on the other parties. Security Commissions and government has no problem. There's no regulation about it. Of course, they regulate it after what we call 2008. I don't want to talk about it now, but it's a little bit, have been regulated. Anyways, this is how a contract works. And we already explained it. This is the market rate, and this is the FRA rate. So if the prices goes to, this is the contract, and then after 3 months, the rate goes to 0.775. Now, do the calculation. So what you will do first, it's 3 steps. And I want you to, now when you do the calculation, you have to open your minds. First, you have to understand it's 3 steps. Second, you have to understand who is the buyer and who is the seller, because somebody will be compensated. Now, when you start calculating, you calculate the market. Step one, market. Step two, you market the FRA. And this is the formula. The formula is given, which is you will take the 500,000, the value of the contract, times 365, 36,500, which is actually the 36,500, 36,5 days, 365 days. I mean, the formula was adjusted to have a continuous, discounting. Remember, this discounting actually, you are discounting it for 6 months. So actually, this is a discounting of 500,000 using 7.75 and 6 months. But usually we use this, what we call note formula. So we find this to be 481,593. I calculated according to 7% and I found it 483. And this is easy. Now, from this, and you have to get the difference. The difference between this, we find this to be the 7% is actually higher. So now, if the bank is the seller, now in this case, the bank has to pay the 7.75 and receive the 7%, which means now he's losing this amount. But if the bank is the buyer, now the seller will give him 7.75 and the seller will get 7%. So the bank will pay him 7% and get 7.75. In this case, actually, the bank is the buyer. So the bank is getting the difference between this amount and this amount, which is 1,721. And we will continue with the bank as a buyer, but in a different case, when the interest rate drops from 7% drop to 6%, which means the FRA now is higher. Now, let's look at this case. It dropped to 6%, okay? It has fallen to 6%, then the market rates on the settlement date is 6%. So you have to settle 1% actually. And look at the calculation. At the same time, you will start calculating at 6% and find it like this. And then you calculate at 7%, which is the FRA, find like this. And the bank has to be paying the difference between this amount and this amount, which is now the bank is losing actually, because if he is the buyer, if you assume that in the two cases, the bank is the buyer. I can now tell you what if the bank is the seller, you will tell me just the difference. If the bank is the seller, he will, in this case, he will lose here and he will gain here. If the bank is the buyer, he is gaining here and he is losing here when it is 6%, okay? That's it. Now, do you choose to be the buyer and the seller? It's a smart move and a smart decision. It depends on your understanding how the market is moving. And if you take the wrong position, then you are losing. And this is why all those huge banks like JP Morgan lost around $2 billion in 2013. And so many, one here in Singapore, in Singapore, I think they lost around 1,400,000 in some trades. So if you take the wrong position, then it's actually without hedging, then it's a big problem. So you have to understand the movements of the interest rate, and based on that, you sign the FRA contract. Now, let's now to move, this is speculation. Remember, there is no underlying assets. You just speculate, which means you will settle the difference. There is no underlying assets. You don't need to do that. You are just gambling or speculating on that amount. Let's call it speculations, okay? Now, what about if you are hedging? If you are hedging now, you have what you call position in the market. It will be the same thing. However, the calculation will be the same thing. So just let's talk about hedging when it is 7% and the market increased to 7.75, then you have to make around 1,721. But this one actually has to be offset, has to, if you are a buyer, now in this case, you have to pay some payments, and this is actually to top your payments and your commitments. To make it clear, look at this example. And please don't worry about all those colors and all these things. Let me just move here first. Now, this is the FRA market, and this is the physical market. This is the physical, this is the FRA market. Let's go now to the FRA market. You go on a contract, this is the contract. The rate now is the FRA 7%. This one. Now there is two, after 3 months, there is two possibilities. Either the rate will go to 7.75 or the rate will go to 8%. So now, excuse me, the rate goes 7.75 or 6.2%. Now, if you are hedging now, all the time as a bank, if you are hedging, all the time you want to pay the 7%. So in the first case, you will pay the 7%, but the rate in the market already 8%, 7.75. Somebody has to pay you 0.75 basis point. Somebody has to pay you 75 basis point. Now, in the second case, if the rate is 6.2, you have to pay, you still use the 7% hedged, and you have to pay the seller 80 basis points. Now, let me just go and see how the physical market works. Now, the physical market, look, the physical market, this is this is the forward contract. So the market is 7. Let's take the first. Let's take the position one. Position one here. Now the rate is 0.775. So in this case, you will offset. This is your position in the market, in the physical market. You have to pay 7.75. You are only fixed rate for you are receiving fixed interest rate of 7%, but the market now is 7.75. Somebody has to pay you the 70 basis point, and this 70 basis point is coming actually from the forward market, from the derivative market. This is so end of the day, you will compensate and you pay 7.75, 7% from your physical market, which is from the borrowers or whatever, and 75 basis points from the counterparty. The situation here is different. You still receive, you are receiving 7%, but you need to pay only 6.2. You are hedging the changes in the interest rate. So actually the rest of it will go to the seller, which is 80 basis points. So as you can see, the move here is you pay what we call 8 basis point will go here. Here, as you can see, the 0.75 will coming from here, and it's actually will offset here. Here, the offset will be the opposite. So this is how the hedging. Now we are talking about interest rate. You can talk about oil prices. Oil prices today may be 62, and the delivery after 3 months, and the prices is CIF, which means arrival to client port or to your ports. If the prices come while the interest rate, while the oil prices is already 65, and your physical market and your contracts inside the country when you decided to go to this transaction is only 62. Now you need to buy the seller, which is the Saudis, for example, who send you this oil, 65. So 62 will take it from your contract, physical contract, and $3 will take it from the what we call the forward contract. You top it up and you pay to the Saudis 65 or the oil seller. So this can be to interest rate, can be to commodities, can be to anything. You can also look at here, this is just the explanation, and this is, as I told you, the compensation, how much you will compensate according to this contract 17. If we are talking about this contract, if it is 7.75 and 7%, you are paying 721. I didn't calculate the 80 basis point, but this is for the first part here. The settlement will be in dollars is this amount, which you already calculated. And this will be paid from the seller to the buyer. Okay. Now let's go to the third issue, which is the trading. Now, what we call it, providing risk management. Risk management, banks are smart. They take position in the middle, and they can work with inside as sellers to the buyers and as buyers from some other sellers. But here, for example, they make contract in this area. Remember, it's like the contracts we have seen there. It's just different. So they are taking these two positions. One position here, where they are, the bank is a buyer, and the bank is a seller, and it's a buyer. And this is, I give two examples here. And they take another position. Remember, it's 10.5. And then they take other position where it is 10.10%, where they are the buyers and sellers. Now, if they are very smart, and their exposure, which means the amount of dollars in this contract as a buyer is equal to the amount of contracts with their sellers, they are gaining all the time, regardless of the movement of the interest rate. Now let's look at this. For example, the interest rate could go to 10%, the market interest rate. See, this is the FRA contract, which is the fixed contract. When the bank was a seller, 10.5. When the bank were a buyer, was 10.10. Now assume the interest rate goes to 10%, which means drop. Now FRA is higher, which means now in this case, the bank has to receive from the buyer 0.50. And in this case, the bank has to pay to these people, because it's 10%, they have to pay 10 basis points. They make 40. Look at the second position. If it is 11%, the bank now has to pay the buyer here 50%, but have to receive from the sellers here 90 basis points. 90 basis points, and here they pay 50 basis points. The difference is 40 basis points, still the same. Now, let me do it in calculation. This is the two position. Now, if the bank is, this is the when the interest rate goes to 10%. So he will settle as a seller 10% and receive 10.5. It's clear. Receive 10.5 and sell for 10. So he will the buyer will give him the FRA, and he will give him the market, and this is what he did. He will base the market. This is the market, and he will receive the FRA. This is the FRA. How much he makes? He makes 50. But in the same times, in the other positions, he will pay the FRA when he is a buyer, and he will get the market. Of course, he's losing now. How much? He's losing 10 basis points. But the difference between this and this is 40. 10 and between this amount and this amount is 40 basis point. Same thing when the interest rate goes to 11. So he has to pay, he will receive what we call, he will pay the market if he's the seller and receive the FRA. This is the FRA. He will lose now, how much? He will lose 15. But in the same time, when as a buyer, he will pay the FRA and receive the market. Receiving a difference of 90 basis point, receiving 90 basis point. If you look at the difference between this and this, it's 40 basis points. So all the time, whether the market goes up, he has 40%. If the market goes down, 40%. The secret here is if you are smart in taking the right positions in terms of dollars, your exposures in this area equal this exposure in this area, you are fine. But if you did like JP Morgan in 2013, you become the whole market, you become a seller market or the buyer market. When the interest rate goes up or down, you make all the losses. I'm done for the second part. I hope this part was very understandable. It has some calculations, and this calculation will be hopefully, for sure, it will be reflected for and test for, and hopefully you will manage very well with it. Okay. Thank you so much, and see you on the tutorials and in the workshop. Bye-bye.